So joining me now to talk more about why certain countries are returning better results than others is John Calverley, head of research for Standard Chartered Bank. His latest research note is called the 7% Club. A report looks at countries which have achieved GDP growth of 7% or more for an extended period. Thank you very much for coming in to speak to us. So tell me, do the results of this survey really surprise you, with emerging markets overtaking the US in terms of where investors are putting their money?
Well, the US is growing only slowly, and there's lots of concern about the outlook, whereas, as our report says, a lot of emerging countries are growing very, very fast. We identified countries growing at 7% or more. The point of 7% is that's the rate at which the economy doubles every 10 years. And there's a lot of countries doing that now.
And there seems to be ongoing concerns about the strength, the sustainability of the economic recovery in the US. What are your expectations of growth in the US for the rest of this year and next year?
We're not expecting a double dip, but we are expecting growth to run along only about 1 or 2%. And with inflation declining further, we think core inflation will go definitely below 1% over the next 6 months. We do think the Fed is going to come in and do more quantitative easing at some point.
When we look at some of the emerging markets that are enjoying sustained economic growth that you speak about in your survey, the 7% club of GDP growth, Latin America, you've got the likes of Mexico, Brazil. Tell us a little bit about what's fueling that growth.
Those countries potentially have the growth. It's still the usual suspects are in Asia. It's China, it's India, but also it's Vietnam and Cambodia. What surprised us a bit looking at it was how many African countries are getting in there now. And we suspect 4 or 5 African countries could be in there over the next 10 years or so. Ethiopia, Tanzania, Uganda. And I think there's a lot of interest there now in these frontier markets, which I think offer opportunities.
Of course, Brazil, Russia, China, India, really the 4 largest emerging countries by GDP, your measurement. Is there perhaps a little too much focus on the BRICS?
I think there might be, because actually what really matters is growth, and that's why we concentrated on 7%. If you're a BRIC, a large country but growing slowly, which is potentially the situation for Russia, for example, possibly even Brazil, you could easily be overtaken by a country like Indonesia, which is coming from behind but growing fast, and growing faster than in recent years. So that's why we want to focus on growth rather than sheer size.
So there could be lucrative business opportunities in those countries that are just catching up with the larger countries, as you say. What about the challenges to sustaining economic growth? Because there have been concerns about an overheating economy in China, about inflation being a threat to economic growth.
These are always concerns. The problem for China is how to manage the exchange rate situation and the imbalances with the US, how to deal with the influx of money, which threatens to create inflation or indeed create overheating and overinvestment. We think they'll be able to manage this, although growth we think will slow somewhat, but still stay above the 7% range.
Tell me a little bit more about business opportunities in emerging markets.
Well, the trick is this growth. As long as there is growth, then you have expansion across the board. You have small and medium enterprises doing well, which is a big business for us. You have large companies doing well. And there's opportunities. People are open to foreign investment, and that creates growth.
And what are the risks?
The risks really are that growth slows down, that there is some sort of crisis. We've seen that. A couple of the countries that we think will get back into the 7% club, Indonesia, for example, it was there before 1997. Then we had the Asian crisis, and they've been out of the club for the last 10 years. So you can have a bad enough crisis, political crisis as well, and things really can slow down.
And to what extent could poor growth in the US and Europe dampen growth in emerging markets?
I think as long as the US and Europe are not actually going down into recession, then the emerging markets can do fine. You know, in 2008, the US recession, bad news for everybody. But as long as the US is growing, it's okay for the emerging markets.
John Calverley, head of research at Standard Chartered Bank, thanks so much for coming in to speak to us. Appreciate your time.
Thank you.